To remain updated with the latest business news, click on the bell icon.
Hello and welcome. You're watching Business Today. I'm Sakshi Batra. Well, legendary investor Warren Buffett's latest annual letter to shareholders has come out over the weekend, and it's clearly the talk of the town right now. Over the last 6 decades, these letters have in fact become an annual read across the investing world, providing more insights into how Mr. Buffett and his team thinks about everything from their investment strategy to the stock ownership that they may have, and the company culture and the outlook going forward as well. Now, to discuss these key takeaways from this latest letter and to seek insights on the special lessons for investors from here on, I have with me a special guest joining in, Mr. Gauravs. He's the managing partner at Kanov Capital Advisors. He joins right in. Thank you so much, Mr. Sood, for taking out time for us and for this discussion. I want to kickstart by asking you, sir, that you've been following the ACE Investor for a long time now. Help me understand what these annual letters actually mean to you as an investor and follower first.
Thank you, Sakshi, for having me on the show. And it's been a pleasure following Warren Buffett. In fact, his his letters were the first thing or one of the early things that I read in my investing career, and it's been a big kind of a north pole in terms of how should we think about the businesses and how should we act at times when there is blood on the street. So from that perspective, thinking long term, thinking about businesses as businesses, not just pieces or tickers trading on the market. All of these aspects, time and again, he has highlighted in his letters, and many among the investing community look forward to the letters as they come out.
Right. What was the biggest takeaway, or maybe one or two takeaways from this year's letter for you that actually stood out and that you thought were different from before?
Okay. So an interesting anecdote that has happened that I just came across WhatsApp. This is one of the, in fact, this is the shortest letter that Buffett has written to the shareholders. It's only 11 pages, and in terms of the word counts, also it's the smallest.
Okay.
So to some extent, it does feel like that most of the things that he wanted to highlight have kind of been highlighted, and more than the letter now, he takes the AGM now as a point where he likes for people to question him on varied topics, where he and Charlie Munger can talk about them.
Absolutely. What you pointed out in your first answer, let me take a cue from there only, because in this letter itself as well, Mr. Buffett had said that Charlie and he are not stock pickers, they are actually business pickers. So help all our viewers, many of whom are also new age investors, first time investors who entered the market in the last 1 or 2 odd years, help them explain as to what could this mean as a success mantra for them as well.
So, Sakshi, the important aspect that Buffett is highlighting out here is that they try to make money not out of picking securities when they are in a momentum zone, or they are going up or going down. What ultimately they are aiming to do is buy good businesses when they are available at a discount to their intrinsic value. And this holds true, especially in today's context, because a lot of new age companies have listed in the Indian stock market. Companies like Paytm, Zomato, Policy Bazaar, and none of them have any positive cash flows. And there is no visibility in terms of when those cash flows will turn positive in the near future. So when you look from that perspective, for people like me, it's very clear that it doesn't make sense to kind of buy into those stocks where you can't discount the future cash flows going into the future. And if you are buying a business, it's just like buying a bond where you're looking at the cash, the payouts, the coupons that the bonds will give over the next few years during the duration of their life. And you discount them with the current interest rates to say what the value is. In the case of business, while there is a variability in terms of the cash flows, but it's only those cash flows that will determine the kind of intrinsic value that you are willing to pay at this point of time.
Right.
So,
And yeah.
yeah, please.
Yeah, actually, you're right, because I was about to ask you about the new age businesses, and that was also because Warren Buffett has in this letter lauded Apple quite a lot, and Apple
Yeah,
CEO Tim Cook as well. And this comes at a time when we are actually seeing new age technology stocks across the world first rising with huge valuations and going bust with failed earnings as well. So, with respect to India, how would you really suggest Indian investors to really look at this place and this entire space and
so
differentiate the good apples from bad?
yeah. Sakshi, an interesting anecdote out here is the fact that Buffett made a big bet on Apple about 3 years back, and since then we were just analyzing the numbers, and Apple itself is now 47% of his listed portfolio, as per the letter.
Mm.
And this is huge, given the fact that at one point Buffett used to say that he would stay away from technology.
Yeah.
But now, adding to that caveat, there is a big difference between Buffett and the other tech company, Apple and the other tech companies that I talked about. Apple now throws huge cash flows out of its business. Its operating profits themselves are of the order of close to $200 billion,
Mm.
and Apple has been using those cash flows to in fact buy back its own stock. So, so in my mind, there's a very clear difference between uh, investing in Apple or a Google or a Microsoft versus investing in a Zomato or a Policy Bazaar. So,
You're right there. Also wanted to ask you, he has used another phrase in this letter, and he has mentioned that there is, bull markets breed bloviated bull. So while talking about deceptive earnings, which have also become more frequent. Is that something that you would like to warn Indian investors of also about? And are there any case in points, case studies that they should look at over here?
yeah. So, what has happened over the last couple of decades, especially in the US, companies they tend to report their earnings adjusted for one-time costs. Now these one-time costs keep on creeping into the earnings for every year, and they are never really one-off. And that is an accounting gimmick that many of these companies are playing out to say that they're trying to highlight, basically inflate the reported earnings, what the actual earnings are. It's something like a company saying that we acquired a business and the money has already been paid, and there should be no amortization to that business. But then over a period of time, it's the cash flow of the business that you paid for when you acquired the businesses, and if you are acquiring them at high valuations, then it's clearly a negative sum game for you. And
Hmm.
and many companies then just in one go just write off those things and say this is a one-off item.
Yeah.
And that's where the accounting gimmickry that Buffett doesn't like at all, and he keeps on highlighting in his letters time and again.
Right, right. Also, Warren Buffett has mentioned in this letter that in the current market, there is little that excites him or them at this point in time. Do you also see lack of opportunities in the markets right now, even though Buffett is all open to acquiring more deals and looking at interesting opportunities? Perhaps there is nothing much that is exciting him or for Indian investors. What would you say?
So, from Buffett's context, what has happened is that uh, he has a habit of storing cash to the point where when there is a big correction in the market, he would like to buy that. And that's the playbook that he played out in 2008.
Yeah.
In 2020, when the big correction came in, what happened was that the Federal Reserve in the US immediately acted upon it,
Yeah.
and the securities never were in that down phase for a long period for him to be able to buy into to many of those opportunities. So So for him, the very fact that Fed, we investors now use the term called Fed put, that in case there's any sharp correction in the market, there is always the Fed who will then protect on the downside. But as per Buffett, this creates a moral hazard, and that is so. He has always said that I want to be disciplined about the businesses that I want to buy. I will only buy them at a discount to their intrinsic value, and if I don't see that discount, then I would rather stay away. And he's held true to that. In fact, another thing that has happened in this letter is that he says that since I don't have any other opportunity to buy other securities, then why not I buy back my own securities? So over the last 2 years, he's bought over $51 billion of his own stock. And he's given numerous examples to highlight how that impacts. So one of the things he highlighted is that on a per share basis, the float that their insurance business had was about $77,000. Now, after the buyback, it's increased to $99,000. So, what he's highlighting is by buying back his own shares, he's able to create more value rather than buying a third party security.
Absolutely. He also said that Berkshire Hathaway will perhaps hold $30 billion of cash and equivalents always. He also said that, he really prefers that Berkshire Hathaway remains financially impregnable and never dependent on the kindness of strangers. So how would you decipher this in terms of the value of cash for investors?
So, Sakshi, what he's highlighting is that it's this promise that he has a bulletproof balance sheet and this amount of money standing in reserve that allow him to be one of the biggest reinsurers globally. What that means is that in case there is any big accident or a hurricane or an earthquake, then ultimately when you insure yourself against any kind of a mishap, then what you're getting is a promise from the insurer that I will give you the money in case this happens. Now the value of this promise is only backed by the net worth or the cash that insurer carries, and that's why he takes pride in the fact that they have carried this kind of cash, which is a minimum of $30 billion of cash lying on their balance sheet. So in case any mishap happens, they can pay out immediately, which is not the case with many other insurance, and there is always the risk that they can go bankrupt.
Okay. Timelessly, since you always say that, Warren Buffett's lessons, they always stand the chance of time, where you have seen that time and again in any of the cycles of stock markets too. We are facing another churn in the stock markets right now. On the one hand, we have almost seen the best of bull market in the last 2 years. At the helm of affairs, we are faced with challenges across the globe, including the geopolitical tensions, the worsening macro headwinds at this point in time. What would be your favorite quote from Warren Buffett currently to deal with the kind of situation that investors are faced with?
So the one quote that I really like about his is that he keeps on highlighting that in the short term, market is a voting machine, but in the long term, it's a weighing machine. What he means by that is voting machine is that is more driven by the sentiments at any particular point of time, whether a stock is in fancy or a sector is in a lot of discussion, and because of that creates the demand and raises the valuations of the underlying companies out there. But what he's trying to highlight, it's not where the stocks are valued. What is more important is how are the earnings growing over a period of time, and those earnings are what will give it the valuation that it should rightly get.
Absolutely. Also, help us understand in the end, how are you looking at the current market scenario, and what are you advising investors to adopt at this point in time as portfolio strategy?
Sakshi, I have a slightly different view on trying to predict the market.
Okay.
over a period of time, I definitely have tried doing that, and I'm wrong more often than right. So,
Okay.
one of the mantras that our team has started to do is that one doesn't try to predict, one tries to react to as to what is happening around here. So, from our perspective, what we have done is that as the market rose from the throes of March 2020 and the valuations gave up, we ended up selling a bit of the securities which we thought were going into the overvalued zone,
Okay.
and and it was kind of a reaction to what the market was doing to their share prices. We ended up selling them, and we continue not to buy because we don't find value. So what happens is, as the market goes up over a period of time, the cash component in our portfolio starts going up, and
Okay.
we are waiting for an opportune time now. Now this crisis, if this plays out over a longer of period of time, and if it that causes correction, that is the time where we can deploy that cash that is lying in our portfolio. It's
And where
quite.
would you be looking at these opportunities? Would there be any specific sectors that you're looking at deploying this cash when the opportunity comes?
So, Sakshi, I'm not a SEBI registered portfolio manager, so would not like to comment on specific securities. But sectorally, what we feel is that some of the sectors would gain advantage. One of the big beneficiaries would be textiles and garment exporters out of India, since India has just signed a FTA with UAE. It's negotiating one with UK, one with Europe, and and China increasingly is becoming uncompetitive in this space. So there is an opportunity for India to grab market share out there. Similarly, in chemicals, this China plus one thing has become something that many companies, many countries have to think about, and India fits into the bill because of many strengths that the companies out here have in the chemical sector. What had
Okay.
happened earlier was that the chemical companies, their valuations have shot up over the last few years, but there has been a decent correction over the last 6 months. And at some point, I do feel that some opportunities might emerge out there.
Okay. In terms of asset allocation, would you be looking at large part of equities itself going forward from here, or would debt and gold also feature in?
So, Sakshi, and then again, coming back to this year's letter, Buffett highlighted the fact that ever since he jumped first time into equity,
Yeah.
it's always been that 80 to 100% of his net worth has been in equity, and this is a time when they are closer to 80% right now, which is the lowest they are willing to go. In my case, again, a majority of my net worth would be in equity, and and so for us, debt, gold are just alternative channels to park our money till the time we find opportunities in the equity market. And uh, for that, you have to be a long term optimist on the future of India. So as an
Okay.
investor, that is something that you have to fervently believe in.
Okay, as an investor, believe in the long-term, effectiveness, and be a long-term optimist on equities and the story that the Indian equities may have for you. On that note, thank you so much, Mr. Sood, for sharing all these insights with us on Warren Buffett's letter and the key lessons that investors can pick from this year's shortest ever letter, perhaps. So, thanks a lot for sharing these insights with all our viewers. Pleasure having you with us.
Yeah, thank you, Sakshi, for having me on the show.
Thank you so much.
If you like the video, do like, comment, share and subscribe.